We're talking mortgage again. This time, got my main man, David Hochberg, back in the hot seat, and we're going to discuss what happens when everyday Americans get themselves into a little bit of credit card debt. Just a little bit. And look, there's nothing to be ashamed of. It's fairly natural, and there are solutions that you shouldn't have to live with this burden. And you're not alone. Hawk, help me out here. You've recently just had these clients come in your office, right? They probably listened to your radio show, WGN Radio in Chicago, Illinois, and they called you up and said, David, I need some help.
Yeah.
What'd you help them with?
40-year-old couple. I think he was 47, she's 45, combined income, a little over 200 grand a year. $600,000 home in the western suburbs. Sound great?
Yeah, sounds amazing.
3 kids.
Yep, check.
Everything's rolling, ton of equity in their home. $118,000 worth of credit card debt, 401k loan. They just got on that credit card treadmill and it kept speeding up. They had some health issues, it kept speeding up. Kids are in travel hockey and travel lacrosse and travel baseball. Everybody knows travel hockey, that's 25 G's, $400 stick, right? Baseball bats are $300-$400. Can't say no to the kids, can't put them into the club league, you got to put them into travel. Now, I'm not judging, just telling you, you get on the treadmill.
I was going to say, the society we live in, yes.
This is where we're at.
Yes. In reality, I would love to have that debate, maybe on maybe on an upcoming podcast episode you and I could do, but keep going.
Right. What, not buy things with, don't buy things you don't need with money you don't have?
Well, pretty basic, yes. No, I would love to do a podcast episode. Maybe you and I can do one together over at the Loan Officer Podcast, but I would love to do one where I promise every parent out there, I can guarantee their kid a full ride to a state university.
Okay, that'll be great.
It's real simple.
Okay.
Take all that money you're paying into travel sports, put that money into a 529.
Yep.
And then just have your kid play rec ball.
Right.
And all of a sudden, you have more money. Yes. You'll have more time.
College is taken care of.
College is taken care of. You put the money in the 529, and you still made memories. Your memories weren't at a hockey rink, and they weren't at a ball field 24/7, 365.
Right.
But you're taking vacations together. You're going down to Florida together. You're going on Alaskan cruises together. But I can't get my friends and your friends and most of Middle America, our neighbors, to want to buy into that concept. But that's probably for a podcast episode.
Yeah.
Today, we're talking about actually these clients that recently came to you with the $600,000 house. They have the 3 kids. The 3 kids are in travel sports. They make really good money, 200 grand a year.
Yep.
Right? There's people that give their left arm for that.
That treadmill is picking up speed. That treadmill of debt.
Keeping up with the Joneses.
And the Joneses are broke.
Okay.
The Joneses are broke, and you're trying to keep up with them. So now it builds. They got up to $118,000. Took out a 4 on credit card debt, short-term consumer loans, which we both know.
You're talking about like 19, 21% interest rates.
If you're lucky, it's more like 27 to 35.
Ouch.
Okay, so you mix that in with the $118, it's just a recipe for disaster. So long story short, took out a 401k loan to boot because they were trying to pay off debt that wasn't happening. So they heard one of the commercials how we helped somebody in a similar situation here in Chicago. One of my guys called them up. Long story short, Cash-Out Refinance, consolidate everything together. Okay, we took them out of their 3% COVID loan, took their mortgage plus the 118 plus the 401k loan plus 20 grand more for an emergency fund. Okay, because
this is huge. I know where you're going with this. Keep going.
So consolidated everything down. I told them, like I tell everybody, you've got the FBI and bank regulators are going to be calling you because you've been running with $4.50 average balances. Now you're going to drop 20 grand in there. They're going to think you knocked off like a convenience store. Yeah. Okay, you're not going to know what it's going to feel like. Number one, not to carry all that debt and have all the credit card bills stacked up on your dining room table because you got to figure out which one to pay and how much you got a minimum. They're all gone. 401k loan paid off. Saving a G note a month. Got 20 grand in the bank. Stress is off.
Okay, I'm going to make you almost rewind this, and
Okay.
we're going to slow it down a little bit. So we know the house is worth 600.
600 G's.
Okay, what did they owe on their mortgage?
I think it was like 231 or 221, so low 200s.
Yeah, let's just call it 230.
230.
So you all come in and you say, first and foremost, good news, bad news. Good news is I can help you.
Yep.
And the help I'm going to give you is going to save your marriage.
Yep.
The help I'm going to give you is going to give you this thing called emergency fund that you've never had. It's going to save you $1,000 a month. It's going to help make you a more focused parent because you're less worried, you're less stressed out.
And enhance their credit scores when all the debt's paid off.
And enhance your credit score, which will just save you tons of money and interest in the future. But that's the good news. Bad news is that 3% interest rate that you're able to achieve during the COVID years is gone.
Right.
But it's not about interest rate. It's not about interest rate. It's about the monthly payment, and it's about what you're able to do. So we know we pay off the first loan at $230.
Yep.
We know we pay off the
rounded up to
$120,000 in credit card debt, probably the $40,000 they owed on
the 401k.
The 401k. Plus you gave them $20,000 in emergency, like just cash. Cash that sits in a savings account so that the next time life throws them a curveball. Because life's going to throw us curveballs. That's what life does.
God forbid moment.
Someone gets sick, someone get injured, someone have their hours reduced at work, whatever the case may be.
Happens.
When that happens, when you have an emergency fund, you don't have to go to credit cards.
Correct.
You go to your emergency fund, you borrow money from yourself at 0%, and you deal with life, and then you put together a plan to get that money replenished. So you're able to do all of that. The only thing they had to do is unattach to that sexy rate and learn it's not about the rate, it's about the payment, it's about what you can do for them. Like, this is powerful, and I'm guessing, because I too am a mortgage lender, you still left them with $120,000 of equity, if not more, in their home.
More, because if you figure, it was like 220 plus 120, right?
Yep.
So that's 340 plus another 40, so that's 380, and another 20, it's 400. So I think the final loan amount was right around 400. They had a $600,000 value. Still a ton of equity there.
So the market could literally tank, right? You could see home values go down by $60,000.
They're still fine.
They're still fine.
They're still fine.
They're still fine. Yeah, no, I absolutely love that. Do you do this often? Like, when I look at your firm, your team, are these types of conversations that you're having?
Every day.
Every day.
Every day. I was told by a former executive at our company that my team at Lower does more cash-out refinances than everybody else in Lower combined. Because I'm on the radio stressing that every single day in my commercials. It's not about the rate, it's about the monthly payment. We're giving these examples. And everybody that's listening to these examples are like, that's me. Or that's my sister, that's my brother, that's Tommy at work, that's Sally at work, right? Or, hey, that's my mom, or that's my brother. So these are real life examples. I don't need to make these up because these drop on our desks every single day. And the best part is, we don't talk about interest rates. Okay, it's like, here's the monthly payment where you're at. Here's the monthly payment where you're going to be. Here are the closing costs. Most of the time, if we can, we cover the closing costs because we want to bring them back in 6 months and redo the loan. Sometimes we have to put them into an FHA loan because their credit's rocked and we can't get them into conforming. And then sometimes the rate's so high, what's an extra quarter of a point, right? And let us cover your closing costs with a quarter point more. If rates drop in 6 months with the higher credit score and you're not taking cash out, you're not getting hit with the loan level price adjuster, we'll take a look at it. If we can get you down a half a point or 3/4 of a point and cover your costs at that time, we'll just walk you down every 8 months or 7 months, whatever it is. So we're not just a one-shot shop. We're here to put yourself, rearrange your financial furniture, put your family in a much better position, take the stress off of your family. It's all about the family. We're bettering your family's financial situation, taking the stress off so you and your wife or you and your husband and you and your kids could get back to normal and you're not stressed out every single day and freaking out.
You know what's crazy is that I know people are listening right now and they're like, he makes it sound so easy. But you know what?
It is.
It is.
Right.
When you work with professionals. So check this out. If you feel like this is someone you know, if you feel like this could maybe even be you and you want a free consultation, it's no obligation, but it's a free assessment. Go ahead and click the link down in the description. It'll take you to a brand new page, fill out the questionnaire, and by doing so, you're going to guarantee yourself a conversation one-on-one with this guy right here,